review for the week of June 23, 2014. I'm JJ Schinkelberg. The Consumer Price Index, or CPI, is a commonly used proxy for inflation. It measures the change in prices paid by urban consumers for a representative basket of goods and services. On Monday, the CPI measure was reported for May. This report showed CPI rising 2.1% year over year, a higher rate than the market had anticipated, and marking the third straight month of solid gains. Much of the gain may be attributed to higher food and energy prices, with food prices up 0.5% and energy up nearly 1% from April. The CPI report tied in closely with another noteworthy event this week, a two-day meeting of the Federal Open Market Committee. The Fed maintains a long-run inflation target of 2%. Measures higher than this indicate the Fed may choose to tighten monetary policy sooner rather than later in order to keep inflation within their targeted zone. Despite the higher CPI reading, the Fed directive and press conference indicated ongoing patience to remain accommodative. Historically, higher inflation will have a tendency to indicate higher bond yields. Higher bond yields due to inflation have had a tendency to pressure equity prices due to an expectation of slower economic activity. Interestingly, this has not been the case this week or for the past 12 months. In fact, a review of the past 12 months ending May 31, 2014, indicates equity price advances on days when yields have risen have significantly outpaced price movements when yields have fallen. Total return for the S&P 500 index on up yield days has been almost 25% versus 16.5% for the full year period. Cyclical sectors like technology and industrials have benefited the most. Why would signs of advancing inflation and higher bond yields correlate with higher stock prices? Most likely, investors are saying that improving employment trends and global economic activity can tolerate a modest uptick in yields and inflation. $1.2 trillion, equivalent to 90 weeks of net income, sits on the balance sheets of S&P 500 companies. With this much cash, companies are in a better position to grow without relying on higher cost debt to slow earnings momentum. For now, we appear to be in an equilibrium state where equity price momentum and employment trends say corporate conditions are strong enough to withstand higher rates and modest inflation. Where do we invest in these conditions? Technology and energy, two of our innovation sectors, appear to be attractive. That concludes our update. We will see you back next Tuesday. Have a great week.